Well, greetings if you're online, and today we're going to be covering the last two sections of the Chapter 26 notes. Those are the two remaining methods for capital budgeting: the net present value method, the internal rate of return method. And that will finish out the outlines I have for you in the file. So first of all, the net present value method. If I share my screen here with you, show you what that is. So this will use the interest factors that we covered last week. So net present value method. Net present value is the net difference between the present value of the investment's net cash inflows and the investment's initial cost. We'll compute with both equal and unequal periodic net cash inflows. Actually, we'll just do periodic, equal periodic net cash inflows in this class. So net present value with equal periodic net cash inflows will constitute an annuity. And the net present value equals the amount of each period's net cash inflow times the annuity present value factor that we'll look up. We'll subtract the investment's initial cost from that. So we're hoping that what comes into us in the future in the way of cash flows far exceeds this initial cost of the investment. That way we made lots of money off the investment. So the higher the better with net present value. Let me skip over C for the time being. D, if the asset has a residual value, that residual value or salvage value should be discounted as a single lump sum. And the present value added to the discounted amount of the net cash inflows. And the first sentence in E, the general decision rules that the company will decide to invest in the asset if its net present value is greater than 0. So we'll see that work. I'm going to skip down to H and take a look at two examples. Short exercises 2612 and 2613. And to do these, excuse me, I'm going to be looking at the file that I have on Canvas, where I scanned these problems for you. So let's look here at short exercise 2612 first about using net present value to make capital investment decisions. So we're to refer to the Hunter Valley Snow Park Lodge expansion project that we had the other day. And what is the project's net cash inflow? Is the investment attractive? Why or why not? So just to kind of review what we had with that Snow Park Lodge, it's right here on the first page of these problems. So we're to consider how the Hunter Valley Snow Park Lodge could use capital budgeting to decide whether the $11 million Snow Park Lodge expansion would be a good investment. We're to assume that Hunter Valley's managers have developed the following estimates. These may or may not come true, but let's work with them. So we first computed total revenue and total variable cost per day. So number of skiers per day, additional skiers, that is, if we do build this expansion, 121. Multiply that by the average number of days per year that weather conditions allow skiing, 142 days. Then to get the revenue, what we did the other day, we looked at the average cash spent per skier per day of 241, and we multiply by these first two numbers. To get the relevant costs, the costs will go up, those will be variable costs. And the average variable cost of serving each skier per day, $83. So we would also multiply that, as we did the other day, like 121 and 142. So that gives us the relevant costs. We subtracted the relevant cost from the relevant revenue, and we got the net cash inflow from the SKUs. So we'll see the number coming up in just a moment, but we've already computed. To remind ourselves, useful life expansion, 7 years. And cost of expansion, again, 11 million. We have a discount rate here of 10%. Well, that's like an interest rate. It's the minimum rate of return the management wishes to earn. So we'll work with that too. Let me come back here to number 12, where we're going to use net present value. And it won't be bad. Let me show you. Taking a look here and the solution. So here, number 12. Well, we're going to look at this. First, we'll calculate the present value of future cash inflows. By the way, they have a typo. This says 1 to 10 years. That should say 1 to 7. And this next figure should be 7 as well. Well, I'll tell you where the 10 came from. In the last edition of the book, the project had a 10-year useful life. So they forgot to change that to 7. But all these calculations involve 7 years, so we're okay. Well, first of all, the present value of the annuity of the net cash inflows per year. We calculated net cash inflow per year the other day to be $2,714,756. They're assuming that is the same year after year for 7 years. So that's an annuity. The annuity present value factor that we want. Well, the interest rate is 10%. The discount rate they gave us. Number of periods is 7. And that is 4.868. Let's see, can you see that okay up there on the screen? Let me enlarge that a bit. There. I could look that number up on the table if you like, or do you just want to trust that it's right? Yeah, it's right. We did enough looking up to the tables the other day. So when we multiply, we get the present value of this annuity of future cash inflows of $13,215,432. Now we have something to add to that. That's the residual value. We're going to find its present value. It's a lump sum. So we want the present value factor from the very first table, table 1. And if we look it up where the interest rate is 10%, number of periods is 7, the interest factor will be 0.513. Again, you probably just want to trust me, right? Okay. So the present value of this residual or salvage value that we will get at the end when someone gives us $600,000 for this kind of used up expansion, all that present value will be $307,800. So we add the two together and we get the total present value of the net cash inflows, $13,523,232. From that, we subtract the initial investment of $1 million. So the net present value of the project is $2,523,232. So if you will, we made that much off the project. It was profit. So would you say invest? Yes. Net present value greater than 0. So we made a fair amount of pocket change off this. So they remind us just here below that the project's net present value, again, is 2.5 million and change. Based on net present value, the investment is attractive because the net present value is positive. So we have a green light there to proceed. Now there's a little note that says decisions about which investments to pursue and which ones to delay or reject should not be based on quantitative factors alone, not just these numbers. The qualitative factors should also be considered, so non-numerical. And a project that is acceptable based on quantitative factors might be rejected after considering qualitative factors. And a project that would have been rejected based on quantitative factors might be accepted after considering qualitative factors. Okay, so in other words, balance out these numbers with some reasoning process. That's true. However, in this class, we're just going to run the numbers. So, but just wanted to let you know there's a little caution. Any questions there on that? Again, remember I changed the 10 to 7. All these over here pertain 7 years. They did the math right, but they just didn't have the 7 years here. All right. Now, the next problem, I don't even need to turn to the requirement. I'll tell you what it is. They assume in number 13, all the same facts except no residual value is 0. So we'll find that lowers the present value. Lowers the net present value because we don't get any residual. All we get, 1 to 7 years, again, change that to 7. Present value annuity. So net cash inflow, the very same thing that we had before, $2,714,756. Again, we used it in this problem. Annuity present value factor still the same. So the present value of that annuity still the same, $13,215,432. The difference is, again, we have no residual value, so that just goes away. So we compare this, the initial investment of 11 million, net the 2, and we've got a net present value of this project of $2,215,432. So again, not quite as high as in the first one, because we're saying residual value. But would you still say that we should invest in this? Yeah. Net present value greater than 0. So sure enough, the project's net present value is $2,215,432. So based on net present value, the investment is attractive because the net present value is positive. And the same worry about qualitative and quantitative factors. Questions on net present value? Ready? Let me come back to the outline here. Look over why I skipped for the time being. Well, first, net present value with unequal periodic net cash inflows. That's more complicated. But since they're not equal, that will not constitute an annuity. So we must apply more calculations. Well, net present value equals the sum of the present value of each individual year's net cash inflows. So we have to do each one by hand, minus the investment's initial cost. You calculate the present value of each year's net cash inflow. We'll use the present value of the dollar table, treating each one as a lump sum. So just more calculations. You could easily do this using an Excel spreadsheet, by the way. They may have you do this in managerial finance, I'm not sure. But if they do adjust, it means more calculations. It doesn't really add to your understanding of net present value. So I think kind of an exercise of utility, but that's my opinion. I'd rather do things quick and easy. T we covered. E, just remind ourselves once again, general decision rules that the company will decide to invest in the asset if its net present value is greater than 0. However, let's say there's more than one project to choose from. Well, the company may need to choose one immobile assets in which it can invest under the concept of capital rationing. That means, once again, we just don't have unlimited funds. Well, the profitability index is useful to decide the one asset in which to invest. And the company will tend to invest in the asset with the highest profitability index. Now, profitability index is the present value of net cash inflows divided by the initial investment. Well, profitability index, higher is better. It's kind of like a rate of return there. So, present value of net cash inflows, we want that to be as high as possible, of course. Initial investment, we'd like to invest as little as possible in this project if we could get away with it. So we'd love to have a really high numerator, really low denominator. And if we do, that means we will have a high profitability index too. So go for the one asset with the highest profitability index. Now, any advantages, excuse me, of the net present value method are that it incorporates time value of money and also the asset's net cash inflows over its entire life. It also indicates whether the asset will earn the company's minimum required rate of return, in this case, 10%. And also shows the excess or deficiency, heaven forbid, of the asset's present value of net cash inflows over its initial investment cost. Again, we want an excess, we want a positive net present value, that is, and the higher the better. And in G, there's just a little disadvantage. Disadvantage is one needs to compute the profitability index for capital rationing decisions when the company must choose one mobile assets in which to invest. And again, we should choose the one with the highest profitability index. And we covered H. Questions here about net present value. Okay. So let's look at the fourth and last method that we could use for capital investments. That's the internal rate of return method. So this model or method is going to reflect the rate of return based on discounted or present value cash flows a company can expect to earn by investing in the project. And the internal rate of return is the interest rate or rate of return, which makes the net present value of the investment equal to 0. Thus, the present value of the investment's net cash inflows minus the investment's initial cost, that's the present value of cash outflows, that's what we must spend on it today, that difference will be 0. So we're going to force it to equal 0 and find out what the interest rate is at that point. So we're assuming we're really just the break-even point here. Now, the higher the internal rate of return, the more desirable the investment. Again, that makes sense because we always want a greater return. Now, in C, we'll always assume the periodic cash flows are equal. in this class? If so, we have an annuity. So we're going to force this. We'll force the investment's initial cost to equal the present value of the investment's net cash inflows. And if I expand that, right-hand side, present value equals the amount of each equal net cash inflow times the annuity present value factor. We won't know the interest rate, but we will know number of periods. We're going to go through a little bit of a trial and error process to find the interest factor that corresponds to an interest rate, and that interest rate will be the internal rate of return. Now, therefore, if I look here, if I take the amount of each equal net cash inflow and switch it from the right-hand side to the left-hand side, that means I'm going to divide by it. Because on the left-hand side, I've already got investment's initial cost. Now I divide by the amount of each equal net cash inflow. That will leave the annuity present value factor over here on the right-hand side. So we'll derive the present value factor. And then, indeed, we're going to solve for this annuity present value factor, just like we did here, and then we'll find it in our table. And the internal rate of return will be the corresponding interest rate. So we'll try to get a factor as close to that as possible as we look at our table. So let me go ahead and show you an example of this. If I turn back here to the PDF that I have of the example problems. Whoops. So number 14. So in solving to this annuity present value factor, once again, we took the initial investment, 11 million. We divided by the amount of each equal net cash inflow. So $2,714,756. We computed that the other day. Trust me. So it's correct. When we do, we get a factor of 4.052. Now, once we've done that, we're going to go to the present value table. See if we can locate an interest factor really close to that. So that interest rate corresponding to that factor will be up here at the top, but number of periods we want is 7. We do not know yet the interest factor. I'm sorry, we do not yet know the interest rate, but we'll guesstimate it based on that factor. So we're going to look here at year 7, and we're going to read across this row from left to right, trying to come up with some factor really close to 4.052. So we can note that as we go on over to the right, these interest factors are going down. Okay, finally, we get over here. There is 4.039 at 16%. 15% had an interest factor of 4.160. So our interest factor that we computed, 4.052, is really, really close to this one for 16%. So practically, we could say the internal rate of return is 16%. Or if you wanted, we could interpolate. Do that. Okay, we won't do that then. or we can solve for an exact figure using a financial calculator. So let's look at the other file. Okay, we found this interest factor. They give us annuity present value factors. They give us two of them, one for 16%, one for 15%. Same ones we saw on the table. And it's really, really close to this one here for 16%. So that's why I say, and we could say 16%. So as they say here though, because 4.052 is between 4.039 and 4.160. The internal rate of return is between 15 and 16%. It sure is a lot closer to 15%. I'm sorry, it's a lot closer to 16% than to 15%. There's a low note, so using a business or financial calculator or Microsoft Excel, we'd find that internal rate of return is 15.89%. So not really a big or material difference from 16%. We know it's way above management's minimum desired rate of return, reflected in that discount rate of 10% that we saw. So once again, that project's internal rate of return is between 15% and 16%. So based on the internal rate of return, the investment's attractive because the internal rate of return is greater than the company's 10% required rate of return. In fact, we want, once again, that IRR to be as high as possible, just like any other rate of return. So this investment is definitely attractive to invest in. We'll make more again about qualitative and quantitative factors. Any questions here about the calculation? So now if I come back to the notes, looking at why I skipped. Well, first in its periodic cash flows are unequal. Well, we have to use a trial and error procedure in which we discount each, just like lump sums, and compare the sum of the discount amounts to the project's initial cost. We tried to derive a difference which is as close to zero as possible. Now, a financial calculator makes that easy, or something else like Microsoft Excel would. But to do it by hand is cumbersome, so we won't. Well, then F, and just the internal rate of return method. R, that considers time value of money, considers all cash flows over the life of the project, considers the project's unique rate of return to be calculated, and no additional calculations are required for capital budgeting decisions. For capital budgeting decisions, you simply go with the highest IRR. And we've already done G. Short exercise. As I click on my down arrow, whoa, look there. We've completed all the notes, all the outlines. So I'll have a short outline for you next week on Appendix C. I don't even cover the entire appendix, but I just want to have a few highlights of accounting information systems. Any questions here about Chapter 26? The internal rate of return. Okay, well, as we agreed, Tuesday of next week, we'll go over accounting information systems. Thursday of next week, we'll go ahead and take off because we've got, so we're really far ahead of where I normally am in my night class of managerial. Right, don't have as much class time. So we'll take Thursday of next week off and keep shortening, you can use it because you've got plenty of stuff to do. Not for this class, but for others. All right. Well, almost over. So have a good weekend. Come back here. Why? So yeah, almost over. Have a good weekend and see you then on Tuesday. Good Shabbos if you celebrate. And take care. Bye-bye.